We've got a great question here from Brian in the follow-up to our previous question or video about the stop loss placement, saying that if we sometimes do use that second swing point, won't that give us a very bad or negative risk to reward? Now, Brian, excellent question here, and we can use today's NZD CAD as a good example of this. So based on the usual way we approach our stop loss placement based on that previous video, we would have probably looked for a stop loss below this overall first swing, not the second today. The reason for that, it is well within that ADR range. It's below the ADR low. It's also below that swing point, and it's also below the 84.50 psychological level. So all in all, a proper stop loss to take. But looking at the reward or the profit target, if we assumed an entry in this area, and we take it off somewhere in this resistance zone, that would give us a negative risk reward. But remember that when we placed or chose this resistance area, we looked at all the technical information at hand. We had the most recent fair value area. We also had the psychological 85.50, and we also had the ADR high. So based on the probabilities of using this zone as a target, that would have given us a negative risk reward for this trade. Now, based on risk reward methodology, we can handle this in three ways, right? Firstly, we could reduce our stop loss. But if we do that, we drastically decrease the probability of this trade working out, because we increase the probability of the stop loss to be getting hit, even though the most probable place to place it is below the swing. Secondly, to make the trade fit into the risk reward, we could increase our profit target. But if we did that, again, we're not using the most probable areas for our profit target. Now, the third option, of course, to make my trade fit into the risk reward is by simply not taking the trade at all, because based on the highest probability areas in the chart, the trade does not make sense from a risk reward point of view. Now, the challenge with all three of these options, right, is that in each one, I'm trying to make my trade fit into the risk reward, which means that the risk reward is dictating the probability of the trade and not the sentiment that's currently driving the market. Secondly, it also assumes that you will always exit your trade at your preset stop loss level, right? So like a mechanical entry and exit, it assumes that you will never do any type of trade management. So if we always allowed a trade to be closed with the stop loss, then risk reward makes a lot of sense, which is why purely technical strategies it's very important for purely technical strategies. But we are not allowing each trade to get closed at the initial stop loss, right? We use a dynamic stop, which basically just means that we do trade management. That means the moment the reason for entering the trade has changed, the reason for the trade has become invalid, we basically just close it out immediately, whether that is at break even, whether that is at a stop loss, a small loss, or a small profit. The moment the sentiment changes, we're out. Now, like we said in the previous stop loss video, we rarely let a full stop loss get hit, because if the sentiment changes, we just close the trade out immediately. That is why we use a designated area for profit targets as well, because we want to see how price reacts when it reaches that level. We're not just blindly, closing it out there. We want to see whether there's strong enough sentiment to maybe carry on, but that is usually the highest probability area for us to consider taking it off. But, if we are halfway to our target, let's say we enter here and we're somewhere in this overall area, if the sentiment changes, we just get out of the trade immediately without thinking twice. We're not going to allow that stop to be hit. In the same way, as price starts to move in our favor in a particular trade, it's always a good habit to do a trade management to reduce your risk on that particular trade by making sure you move your stop loss up as the price moves up. So in this example, as we moved up, we could have moved our stop either below the level, this overall swing below the actual swing up here, or maybe even to break even as the price started to move in our direction. So in that sense, the only reason why you are anchoring your stop the way that we do is by allowing it room to move, and also to get your analysis, in case you get your analysis splendidly wrong, or there's a massive volatility event that occurs unexpectedly, at least you protect your account from a massive spike. But that happens, that happens very seldomly, and if that happens on a very every day with all of your trades, then you're not trading in line with the sentiment, right? Because if you trade in line with the sentiment, for the most part, the market should be moving in your direction. Now, just to be absolutely clear at this point, as far as it is possible, we will always want to risk less than our potential reward, right? It's not an inherently bad thing. We should always strive for ratios. Um, Let me just say that one more time. We agree that having positive risk to reward ratios are a good thing. But using sentiment to dictate your trade direction and using a dynamic stop loss with a good trade management methodology gives you a much better and higher probability of closing more trades for winners than just purely looking at that one-to-one or hard one-to-two limit in terms of risk to reward. So yes, we always want a positive risk to reward, but if I look at a trade like this and I get less than a one-to-one, I still consider this a higher probability opportunity because I'm trading in line with the sentiment, firstly. And secondly, I'm not going to leave my stop hanging around here. The moment this trade moved up, I did move my stop up to a much more attractive level. And as we head closer to that target, manage that trade, move it to break even. And as it reach that zone, close it out for a profit. You do need to use dynamic stop losses or trade management as to increase your probability of win. So I hope that makes a lot of sense in terms of risk reward. So yes, it is important, but the overall sentiment and the way we manage trades for us is much more important than just using a hard 1-to-1 or 1-to-2 or 1-to-3 risk to reward ratio.